Worried about a market crash? Here's why your time horizon matters than you think. Equity returns keep fluctuating, and with them, investors' expectations. As Benjamin Graham once said, large and quick profits are sufficient to dull the public's critical faculty. When markets are soaring, it's easy to believe the momentum will never end. We have seen this story play out time and again in the early 90s, before the 2008 crash, and even now. Each time optimism peaks, and so do valuations. Investors often pour in the most money at the most expensive phase of the market cycle, driven by fear of missing out, FOMO. But they don't focus on fundamentals. Over the long term, equities are indeed very powerful wealth creators, thanks to the underlying growth of Indian businesses. But here's the hard truth. Many investors fail to capture the long-term gains. Some underperform even other asset classes, and others don't even beat inflation. But every bull market makes us forget that until the next downturn reminds us. So, what is the key question? Are you investing with discipline or just riding the wave? The real cost of mistiming equity investments. It's time. Time is the most important thing when you are investing into equity investment. Many investors take comfort in the idea that equity always wins in the long run. But this belief can be misleading. Yes, equities have historically outperformed other asset classes, that products like bank FDs and all, but not consistently and not regardless of timing. The reality is equities can underperform for years, even decades, depending on when you enter the market. In the case of Indian equities, long-term returns have indeed surpassed those of the debt returns. When markets are priced for a perfection, even minor disappointments, a slowdown in earnings, macro headwinds, geopolitical shocks can trigger sharp corrections. In such scenarios, more conservative assets like debts may actually deliver better risk-adjusted returns. So the next time you are tempted to jump into equities during a euphoric rally, remember, the cost of mistiming isn't just lower returns, it's the time lost waiting to recover. What this means is simple. Markets are far more volatile and prone to extreme events than the standard model suggests, because as history shows, the market doesn't care about your models and it certainly doesn't follow them. The key rule is don't wait endlessly for a market crash to start investing in the market. Don't only move in one direction. For those already investing through a goal-based plan, stay calm. Bear and bull markets are the natural cycles and will continue to alternate over time. If you want to know more about financial planning, subscribe my channel, and if you have any questions, do comment below.